All right, good Friday morning, everybody from York, Maine. As I'm on vacation, I obviously still am following the markets and recognizing that the same way that we began the month of August, we're basically beginning the month of September with a heightened state of volatility, heightened state of fear, markets quote unquote in turmoil. I mean, the first trading day of September, I think one of the worst in history to start any month, let alone September. Right, not a lot of good stuff taking place in the markets right now. If you look through the lens of, just downward price action, but for savvy investors, you have a different perspective on that. You're coming at the market from the perspective of I'm getting cheaper prices in an expansionary cycle with earnings still growing and projected to grow through at least the end of the year. I don't typically favor estimates for the out years. But, for argument's sake, if we do look at those estimates for 2025 S&P 500 earnings, we definitely see them. The analyst consensus is that they're going to continue to grow in 2025. Man, the breeze. I'm literally sitting outside here on a balcony, and I'm blessed to have really good friends. They lent me their summer home here in York, Maine. My view straight ahead is of the ocean. You can't ask for anything better. Truly blessed in that regard. So, with that being said, let's get into some of the content I put together here, kind of looking at markets and people. Right, look, when the markets are down, and again, frame of reference matters. When the markets are down and out, maybe when you're even in a bear market, what is the prevailing narrative, right? Prices are going to go even lower. Now, you would think when the markets are at highs, given that, when the markets are at low, everybody's pessimistic, everybody has the perspective that market prices will go even lower. That when the markets are at highs, people think, hey, we go even higher. But no, everybody seems to want to call a top in the market, right? They're looking for that next major crash of sorts. That's why there's perma bears. Gives them something to do day in and day out. So I want to look at certain charts and or perspectives from around social media that I've seen over the last several weeks, and already here through the first trading week of September. So the first one I want to come across here is from a gentleman called the Norseman One, is the username on social media. And what he's showing here is what happens after the Fed pivots, right? That's the name of the chart. The majority of the decline in these bear markets. So it's important to put into context what is actually being captioned here. And what's being captioned here is the majority of S&P 500 declines in bear markets. So you're already in a bear market occurred after the Fed's pivot. Do I think that's the lens that Norseman One is looking through? No. I think he just got this, grabbed it, didn't really pay attention to the headline of the chart and said, well, hey, I already went to cash. So essentially, I'm trying to avoid a major drawdown. And this fits my narrative. This fits my perspective. So let me just put it out there on the X. I feel like an old man on the X. It's just X, formerly known as Twitter. But anyways, and what it identifies is after the Fed pivots, so I would assume this is to a rate cutting cycle, you had these really big declines. I guess this is going back to the 1960s. Again, after the Fed pivots. Now, this is already in the bear market, but again, is that the condition today? Are we in a bear market? No, of course we're not in a bear market. We just hit the all-time highs in July. We had 38 all-time highs set in calendar year 2024 already. So why is this even why is this even the formula that we're using here? Because this is a chart of bear markets and then the Fed pivots. But even so, that's part of the narrative crime that we are introducing with this chart here. And it completely assuages all of the Fed pivot cycles, right? Because obviously here, 1980s to 1990s, there's no pivots here, which does, again, make it important to understand the context when you're already in a bear market, which we are not today. So it doesn't show any of the pivots from the 80s or 90s. What we have here is just somebody grabbing stuff to fit their already, presumed outlook for future price action and trying to fit a chart to that narrative. As we can see, historically, these are all the Fed rate cuts. After the first rate cut, what happens to the S&P 500 going forward 12 months? Now, the majority of the time, the vast majority of the time, almost all the time, the S&P 500 is up 12 months after that first rate cut. Sorry. Now, there are some significant drawdown periods. Of course, 1973, there was a significant drawdown, and the market was red in 1973 and 1974, but that's a rare occasion. 1981 was another negative, 12-month forward after rate cuts. More often than not, again, you need a recession like 2001. So what this chart shows you is that all the candlesticks that are above the neutral line or zero line are the forward 12-month returns after the first rate cut. And there are far more candlesticks above zero than there are below zero. Off to the right-hand side, you'll also see the magnitude of drawdowns are dependent on recession versus non-recession. Like if we don't have a recession within that 12-month period, more than likely we're not going to have, a significant, even a bear market, a technical bear market of 20% drawdown. All right, let's move on to the next chart. This individual, the reformed trader, QQQ, the biggest warning sign for me, and this again was basically at the end of August. The biggest warning sign for me is QQQ not even coming close to filling its gap like SPY did last week. Keep in mind that QQQ often peaks a month or more before SPY does. Seeing relative weakness in the Qs versus SPY cannot be ignored. Well, it can be. I think, more to his point is that you shouldn't. And I don't want to say force fed, but, this chart from this individual was sent to me. This and that. This is not technical analysis, by the way. Just because you put up a chart and characterize it any which way does not make it technical analysis. Do I concern myself with a lack of tech or Q's leadership, NASDAQ leadership? Relative to the S&P 500? Absolutely, right? I mean, we need the Qs to lead. It's modern Dow theory. It's considered growth over value, the S&P 500 being value, the NASDAQ or the Qs being growth. And you want growth to lead. Heck, that's what's led this entire bull market cycle since the bottom in 2022. So absolutely, the fact that Qs are lagging over the last month or so is something to pay attention to. Is it a big warning sign? You'll only know in hindsight. There's no such thing as real time delivering a warning signal. We could just as easily rotate back into the strength of growth. Heck, what we've seen in earnings from the growth side of the S&P 500, which are obviously NASDAQ related companies as well, they've outperformed every other area of the market. projected to do so to a lesser degree in the Q3 earnings cycle, but still delivering the majority of earnings strength. Again, nobody can predict the future. And whether it's, Seth, well, the market did go down since the Norseman one posted this chart. The market has gone down since this gentleman or reformed trader, I don't want to presume anything. And that's another faux pas. I think it's bad form when you have to play cloak and dagger with your username on Twitter or on X, sorry. Nonetheless, so the market did go down since this this tweet and whatnot. There's a difference between getting lucky and causal. This didn't cause the market to go down any more than this caused the market to go down. The market is just down since, period. Again, nobody can predict the future. We're all doing our best when we look at charts, when we're doing our technical analysis, fundamental analysis, or quantitative analysis. But none of us can actually predict the future. If we could predict the future, why are we playing with the markets instead of buying lottery tickets if we can predict the future and we can know the numbers? That should be your default question, okay, that you ask yourself if you feel like somebody has this prescience, about the future. This was my chart back in 2022. Now look at the date here, October 17, 2022. He was responding to my chart, basically informing that I think the lows are in for the year, and I think we've just started a new bull market. For those of you who know your market history, you remember the market bottomed October 13th intraday and has been up since. He says, or she, that's not what the chart shows. Markets don't bottom. Markets don't bottom. Markets don't bottom. Did I mention markets don't bottom? 3 months before a recession starts. So obviously this person was also projecting a recession. They tend to bottom 3 months before a recession ends. He's not going to be any more prescient here than he was trying to be prescient here. If we go into some kind of a bear market cycle, it will be because of other reasons. It wouldn't be because he was wrong here or he's doing some kind of what he thinks is analysis here. Let's move on. And what happens when the NASDAQ's not leading? What happens when the NASDAQ has a 15% correction like it just did? Historically, you tend to get V bottoms. When we look at NASDAQ composite after 15% pullbacks, we've had 8 times since 1971 or 1978, forgive me, 8 occurrences of 15% or greater pullbacks that basically resulted in V bottoms. 6 months later, the NASDAQ composite was higher every single time. 6 months later, higher 3 months later, you've got an 88% positivity rate. We just corrected 15%, folks. More than likely, 3 and 6 months later, 12 months later, 88% of the time you're still up. The market has, a more favorable outlook, okay? What happens between now and 3 months remains to be seen, right? We could have this very, very choppy. We are in a pre-election run-up time of the year. It's September. September sucks. I said as much in our last weekend research report to Phenom Group members. If you do not get our weekly research report, subscribe today to our contributor membership. It's only $18.99 a month. Cancel anytime. If you want our trades, our investment ideas, access to our Telegram and private Twitter, $69.99 a month. Folks, price goes up every year. For those of you who frequent my video blogs, you know that already, and it will go up again at the end of this year as well. So act now. All right, back to the data. Here's another one. You may not like it, you may not understand it, but from late 2024, a global financial crisis will begin. This will collapse risk assets into Q2, Q3 of 2025, and Fed will respond with extreme amounts of stimulus. But first, you get a blow off top. Folks, This is not technical analysis either. And again, if you can predict the future, why are you bothering with financial markets? Go pick the lottery numbers. Do something better with your time for mankind. Solve world hunger with all that wealth you're going to generate from winning the lottery week after week after week. Everybody thinks they can predict the future. Sometimes people are just trying to get attention. Look at me, look at me. And a lot of people looked at him. A lot of people. By the way, a blow off top is one of the rarest market occurrences. And timing one is likely a lesser probability than winning the lottery. But on X, they'll certainly lead you to believe otherwise. Nothing in the attached qualifies as technical analysis, but rather a roll call of those whose capital will locate to a better fiduciary. You could have literally called for a blow off top at every single one of the 38 new all-time highs achieved in 2024 and been wrong at least 37, because I can't predict if the 38th one will finally be it, but you get my point. You would have been wrong each of the 37 prior times. Bob Elliott, U.S. stocks don't have an earnings problem. They have an expectations problem. With expectations of 3% real GDP in the second half, earnings growth to reach 16% by the end of 2025, and an AI boom ahead driving 21 times PE, such lofty expectations are a setup for disappointment. Maybe. Here's the way I think about it. While I prefer setting low expectations, and I do, it's kind of my whole thing. It's my shtick, as they say. When it comes to earnings analysis, it rarely has a positive expectation, be them high or low. I don't know that I can recall anybody having a positive expectation for earnings. When they're low, when earnings are projected to be low, they're not low enough. When earnings are too high, people always say, well, we're going to get negative earnings revisions. There is no such thing as a positive when analyzing forward earnings. Like, there's no such thing as a positive for crude oil. When crude oil is too high, it's going to crimp consumer spending. How many times have you heard that promoted in the financial media, right? Gas at the pump is too high. How's that worked out in the current cycle? I think the high national average back in 2022 was $4.75 at the pump. The national average. We're still swimming, folks. We're still swimming, right? And when crude oil prices are too low, there's probably something wrong in the economy. You see what I mean? You can't win either way. It's always a negative. There's no such thing as a good price for crude oil. There's no such thing as a good outlook for earnings. So when people say expectations are too high, stop it. There's just a reason to complain and basically just, yeah, but at least I heard myself talking. That's all this is. Bob likes to hear himself talk. Sometimes we all do. I like to hear myself. It helps me think better. I forget how the saying goes. If I want to hear somebody smart, I'll talk to myself or something like that. I don't know. With that being said, the percent of S&P 500 companies this year contributing to the overall price appreciation in the S&P 500 hit a cycle high. Folks, that's what healthy bull markets are made from. How much participation is the market expressing? At almost 78% of stocks having a positive move on a year-over-year basis, that's the most since 2021. For all the hand-wringing and all the loathing about market concentration gains this year, all you had to do was let time take care of things. It generally always does. There's a lot of noise out there, folks. A lot of noise. We like to look at facts. The data is facts. Could this be the first time in history that NASDAQ has a 15+% pullback and it's not higher 6 months later? Absolutely. But a savvy investor does not look at data through that lens. Why? Because they have discipline. You stack the deck in your favor with this kind of data. What you want to do as a discipline is just to lean into that probability. Certainly, there'll be a time where it doesn't work out and you'll take a drawdown in your portfolio. But the more times you actually lean into the higher probabilities, you will be rewarded more so than going against them with your portfolio. You take drawdowns anyways. If you're a long-only investor, if you're a long-term investor, taking drawdowns is just part of the landscape. Volatility being the price you pay for forward or future returns. All right, last one. And again, this is not technical analysis. John, the market sleuth, please stop. Why I believe the SPY will top by October 31st. And this is part of a thread. I traded both the dot-com boom and the great financial crisis. I see few parallels of today's S&P with the 99-2000 mania. What I do see now is an eerie similarity to the Q3 of 2007. I'll begin with the 06-09 chart, which was basically showing the market's top here. And as he said, he sees an eerie similarity to the Q3 2007 period. Here we are, Q3 2007. That is where the market topped. Now, he said, I traded both dot-com and the great financial crisis because this led obviously to the great financial crisis. Anybody who traded during those periods knows, especially if they're doing technical analysis, they know for a fact there was a major breadth divergence. This is the NYSE advanced decline line that peaked basically in June, in Q2 of 2007, and made lower lows thereafter. So you have this downward sloping advanced decline line while the S&P 500 made higher highs. So the S&P's price action was not confirmed by the advanced decline line. Folks, is that what is happening today? No. In fact, the NYSE, the S&P 500, the mid cap, I mean, there are so many advanced decline lines that are making all-time highs going into this month when the S&P 500 has not made a new all-time high. We essentially have breadth leading price. So when somebody says, I traded both back then, and it has a similar setup as today, it has no setup like that. The advanced decline line is at all-time highs, but the S&P 500 isn't. Back then, the S&P 500 was at all-time highs, but the advanced decline lines weren't. You had a bearish breadth divergence. I don't like when people fib. Anybody who traded back then would have remembered that. Careful out there, folks. David Keller, a bearish non-confirmation occurs when Dow Industrials make new highs, but transports do not, signaling potential market weakness. This was May 30th. Bearish non-confirmation, Dow Industrials. Now, we all know what has happened since then. The S&P has gone on to make all-time highs. The NASDAQ went on to make all-time highs. Equal weight S&P 500, the NY, all-time highs left, right, front, and center, no matter what index you look at. More recently, the Dow itself making all-time highs. Just give it time, folks. Don't feed into this characterization. Let time take care of things. Because often, if you wait long enough, good things will happen. Sometimes you don't have to wait long at all. People get wrapped up in the moment, and this is an example of getting wrapped up in the moment. All right, let's look at some quantitative data. As you can see from the title of this segment of our weekly video, rough start again to the month of September. pretty much just the same way we started August, as I said at the top of our video. This chart here is from Steve Depp. And what I often say when it comes to, because what we're going to do here is some quantitative analysis, and that's what this is. This is a quantitative study looking at 4-month win streaks in the S&P 500. 4 consecutive months where the S&P 500 gave a positive return, ending the month of August, or so we think. We can't, I know it started bad in September. We don't know how September is going to end. It started bad in August. We still finished with a positive return. And so, you know, when you look out over the next 1 month period and you look at positivity rates, 73, almost 74% of the time, the next 1 month forward, you get a positive return. Keep going out, folks. There's a lot of white on the screen. Positivity rates get better and better and better and better. 8 months later, 9 months later, the market has never been lower. So what you do with this data is you go to the end of August. What was the closing price end of August? 8 months later, we should be above that closing price. More than likely 7 months, 6 months from now, 5 months from now, 94, 94, 94. Like I said, you got a lot of white. Momentum begets momentum, as they say. Now, here's the other thing, right? That I often say that when you look at a study, don't read the headline. Don't read what it's studying, right? Don't read what the data comprises, what the parameters are. You know, look over the data. See if you can figure out if there's some kind of nuance to that study that stands out at you. And here's the one that stood out for me. If we look at the month end, what do you notice about all the dates? The month, what do you notice? This is the only August, right? It's the only one that, at least with a 4-month winning streak, ended in August. It's the only one. In fact, the only other one that included or encompassed the month of August was right there in October of 1980. So it must have started June, July, July, August, September, October, 4-month win streak. And it just kept going. So how do I read this? What am I trying to say? If only one of these has an end 4-month win streak of August, what does that tell you about September? If you knew nothing else about this study, what it tells you is that there's been no 4-month period going all the way back to 1954, no 4-month win streak that ended in August. Hence, September should deliver positive return. Or this is going to be the first time in history where the 4-month win streak ended in August and doesn't deliver a positive return in September. Do you want to lean into, which one do you want to lean into? Either way, let's suggest, right? Set low expectations. Let's suggest that the S&P 500 does deliver a negative return in September. Folks, doesn't that look like a buying opportunity to you? Because man alive, that is a lot of forward positivity to be delivered. There is right and wrong when it comes to savvy investing. Leaning into these kinds of positivity rates, if price is down, taking advantage, buying the dip is the right way. Going to the sidelines, going to cash is the wrong way. The headlines are not going to improve, folks. They're only going to plague on you if prices get cheaper. When the market does rebound, the headlines aren't going to change. They're not going to get more positive. No, it's just not in the modus operandi of the financial media. It's not how it works. And there are always going to be these people out there, you know, plaguing at every turn in the market. Lean into the data, folks. The data has no bias. It's black and white. It's just telling you, based on this price action, human behavior has produced this going forward. All right, our next piece of data, speaking of September, the S&P 500 performance after a 10% January through July and a negative first 2 weeks of August, which all happened, right? We were up more than 10% from January through July, and the first 2 weeks of August were both negative. We'll look at what happens in the month of September when you have this criterion. 12 times the month of September was positive. Only 4 times was it negative. So basically a 75% probability that September produces a positive return. We've got 2 data points here. Again, just data. Taking all your bias out of it. Remember, technical analysis, there is a certain degree of bias you're injecting based on your comprehension of what the lines are saying. That doesn't look too bad to me, folks. I know September started bad, but so did August. Speaking of how bad August started, right? That first day, rough. All right, this just happened also, right? To kick off September, the S&P 500 forward returns when VVIX relative to the S&P 500 one day outperforms to the degree it did. I think VVIX was up almost 30 points in a single day, and the S&P 500 was down more than 2% to kick off September trading. If we look 1 month out, the S&P 500 forward returns were always positive. So we started the month of September trading on the 3rd. So it basically suggests by the end of the month, if not October 3rd, the market will be higher than the closing value of the S&P 500 on September 3rd. Let's see if we can actually pull that up. Market has opened. We're down a little bit there. Go to the 1 month chart, get the closing value. Come on, Yahoo. Work with me, brother. Doesn't want to work with me, I guess. Year to date. There we go. Okay. September 3rd, September 3rd, closing price 55.28, folks. So 1 month forward, you would be looking based on the data. Based on the data, you would be looking for the S&P 500, 9 occurrences. That's the number of occurrences, this kind of price action between VVIX, which is the volatility of volatility index, versus the S&P 500. All previous 9 occurrences, the S&P 500 was up 1 month later. Pretty choppy, the next week or so. Pretty choppy. Four-week performance following a 1% decline to start the month. Any month, but to start the month. The last 8 times the S&P 500 began a month with a 1% decline, the index was higher 4 weeks later, all 8 times. And we just had a recent occurrence in August. Not all the time. If you lean into, I mentioned, right? When we see these kinds of forward positivity rates, you want to lean into them. If the market's going to give you cheaper prices, you want to accept that as a value opportunity, given the positivity rate going out a month, 2 months, 3, 6, 12. You want to lean into that. Sometimes you don't get the positive return, though. And this is one such study from Wayne Whaley that we didn't get the positive return. After the S&P 500 is up 5% January through May, the August 19th through September 4th period, typically the market is higher. And all of the occurrences, you have 22 occurrences, the market was up 19 times, only down 3 times in this time period. Unfortunately, it's going to be 19 and 4 because because of the way the month of September started. We were positive up until the first trading day of September. So this is one of those times where if you leaned into this data, you would not have, let's say you bought an S&P 500 options contract, you wouldn't have had a positive return. It happens sometimes. All right, what else just happened? Well, as of yesterday's close, the equity only put call ratio jumped above 0.95, finishing at 0.98. Folks, it's like a mirror image of the way we started August. I mean, almost a mirror image. Now, the data above from the sentiment trader, which again, there's the occurrence from August, just above, I'm sorry, right here, just above the most recent occurrence as of yesterday's close in the equity put call ratio. So when the equity put call ratio gets above 0.95, as it did here, and as it did with yesterday's close, 1 month later, the positivity rate is 88%. Very high. But look at 1 week later, also 88% of the time the S&P 500 delivers a positive return. That's how much hedging activity has taken place, right? We saw the VIX get above 20. We saw the VVIX get above 130. It's a lot of fear. It's a lot of panic. Tells you you're getting some kind of oversold condition in the market, at least over fearful markets, overly hedged markets. Hedging becomes too expensive at this point. Typically, 1 week later, after the equity put call ratio gets above 0.95, you have a positive return. A month later, positive return. So we'll see if, just like August when this happened, we did get a positive return a week later, a month later. I think as of Monday, well, let's see, the signal date from the last one is the 8th. So Monday. Monday's trade, because the 8th will be over the weekend. If on Monday we are above 53.28, the 1 month percent positivity rate will jump up to 89% for the 1 week and 1 month. So I know, you see a lot of headlines right now. Things are bad, employment, labor market. Today's, I'll give you my take on the non-farm payroll report that came out. It missed the estimate of 161,000 jobs being created. That was the estimate. It came in at 142. The revisions to the prior months down about 86,000, negatively revised. The unemployment rate, as we expected, ticked back down from 4.3% to 4.2%. What I would say is, all in all, not the best report. I don't think that was the most positive report, my opinion. It wouldn't surprise me if we got, a little bit more fear in the market, some of the oversold conditions dominating, maybe today here on Friday or Monday, and giving us just a deeper oversold conditions before some sort of rally ensues. Semiconductors, relative to the S&P 500, they've been performing awfully. And if semiconductors can't get up and go, the market's not going to get up and go, period. And that's despite, as Avago reporting after hours yesterday, raised guidance. They beat top, they beat bottom. It doesn't matter. We're in this particular period where the multiples are getting consolidated across tech and across the S&P 500. Folks, if that's the worst thing that's happening here so far as price action, understand you're getting opportunity. We're not in a recession. By all accounts, there's nothing suggesting we are going into recession, except the opportunity before you. Let's talk about that. It's kind of a mixed bag when it comes to the macro, but it is undeniably still a growing economy. Here we're looking at disposable per capita income has outpaced inflation since 2019. Despite the inflation spike, you still have disposable income outpacing inflation. You can see it on this chart here as well. If we look at wealth, has grown significantly since 2019. When people say that the consumer's struggling, it's ridiculous. There is a difference between the consumer becoming more choosy with their income because they have disposable income in droves. But there's a difference between them becoming more choosy, more discerning, and them being weak or stressed. Having said that, when we look at retail sales through the lens of Johnson Red Book retail sales, which comes out every single week, and it looks at retail sales on a year-over-year basis, was there some kind of lull here? You could argue that, but we're still talking about averaging greater than 5% year-over-year retail sales every week, jumping up to 6.3%, the highest level since the first week of July in just this last week's reading. Where's the consumer weak in this respect? It's not. It's not. Here's a look at the manufacturing. I'm sorry, this is actually services, right? Because the manufacturing slump or recession has been ongoing for 2 years. But every single time we go through the monthly ISM data, the market has a scare, has a growth scare. Knowing that 72% of the economy is consumer-based, and most of the consumption is done via services. It's a service consumer-based economy. It is not a manufacturing consumer-based economy. And services are at a new cycle high. Folks, if the economy was as soft or weakening to the extent that you hear in the financial media, why is rail traffic now going through what will be at the end of the Q3 period, double-digit growth for 4 consecutive quarters? This started in Q4 of last year. We finally made it into positive territory after a rail traffic recession since 2022. But at the end of 2023, we started to see rail traffic grow again. What are they transporting? Well, they're transporting petroleum and petroleum products, growing double digits. They're transporting grains, growing significantly double digits. Most categories are in growth. I tend to focus on petroleum and petroleum products. Why? Because to some degree it's energy, but to a greater degree it's packaging materials. Petroleum is a component in almost all packaging materials. And it's been growing double digits week after week after week and month after month after month. What do you think they're packaging? Consumer goods. Why? Because the consumer continues to buy and spend. These are the things that you don't see on CNBC talked about ever. You've got to be savvier than that. How can we validate this chart? Well, I think when we look at the Dow Jones US Containers and Packaging Index hitting an all-time high, it validates what I'm looking at in the way of certain economic data. Take your drawdowns like big boys and girls, folks. Take advantage of opportunity. With that, I hope everybody has had a great week. And we'll see what things look like when I get back in the trading room next weekend and off my vacation. Take care, everybody.